Hello and welcome to Recertifications of Size or Status, What Contractors Need to Know, a Pelero-Mazza webinar. My name is Megan Connor. I'm a partner at Pelero-Mazza, and in my practice I counsel clients on a broad range of government contracting and business matters, including regulatory compliance, security clearances, intellectual property law, investigations, bid protests, and disputes with teaming partners. For the firm's small business clients, I advise on affiliation issues, limitations on subcontracting, and how to maintain size and status. My colleague and co-presenter today is Katie Flood. Katie is counsel with Pelero-Mazza. Katie advises contractors on government contracting matters in compliance with the FAR and SBA regulations. She also counsels and advises clients on matters including contract negotiation issues, small business subcontracting plan compliance, and issues related to the GSA Federal Supply Schedule program.
Good afternoon. Thank you for joining us.
Pelero-Mazza is a full-service law firm with offices in Washington, D.C. and Boulder, Colorado. We are most well known as a government contracting firm, and for over 25 years we have helped our clients navigate the complexities of doing business with the federal government. We also provide a full range of legal services, including advice on corporate, labor and employment, SBA procurement programs, and litigation matters. Our clients value the diverse array of legal guidance they receive from us and our responsiveness as we guide their growth and secure their success. Indeed, today's webinar touches on issues involving government contracting, the small business programs, and corporate law. We are broadcasting from downtown DC, and we welcome our attendees from around the country. We are having some internet issues in our neck of the woods, so we apologize for any technical issues in advance. I do want everyone to know that the slides will be available after the fact, and we will post a recording of this webinar on demand for all registrants. So even if you miss pieces of it or we go in and out, you will have this available after the fact. We will try to reserve time for questions at the end, so please feel free to submit them as we go. With that, let's get started. We're going to talk about recertifications, and in order to do so, we have to discuss what a certification is for federal contracting. We're going to discuss the general rule for size and status certifications, exceptions to the general rule, recertification itself, and penalties for false certifications to the federal government. So certifications are, the magic point in time is time of initial offer, which includes price. You should also be aware that besides your proposal or your offer, you are also making certifications to the federal government when you register in SAM. And you re-represent your size or status on an annual basis and after any triggering event in SAM. Be mindful that you cannot force your subcontractor to register in SAM, and we'll touch on that later, but for your company as a prime contractor pursuing work with the federal government, these are the 2 points of time. The word certification, it's important to, anytime you're dealing with the federal government and you see certify or certification, you need to pay attention to that word. It has a meaning. It's more than promise, it's more than represent. A certification under the law is a promise to whoever you're certifying to, here, the federal government, that you've done some type of investigation when you're certifying whatever the certification is. It's just a level below a sworn statement. That's why it's so important that when you're certifying your size, you're certifying your status, you know that you are, in fact, representing to the government something that is true to the best of your knowledge. If you aren't doing so and it's found out that you have given a false certification, that can open yourself up to both criminal and civil liability. And I just want to do one big picture concept because we got some questions before the webinar. We're going to be talking a lot about size and status certifications. And when it comes to size, there are two types of size standards. There are revenue-based size standards and employee-based size standards. So at the time of offer, you need to ask yourself, what am I certifying to? Am I certifying that I'm small under an employee-based size standard, or am I small under a revenue-based size standard? To calculate whether you are small for purposes of a revenue-based size standard, you do the average of your 3 recently completed fiscal years. So for any offer with price in the current year, 2017, your 3 recently completed fiscal years are going to be 2016, 2015, and 2014. So it's the average of those 3 years to determine whether you are in fact small for purposes of that contract. Employee-based size standards are a little different. That's a 12-month look back from the date of offer. So it's based on the average number of employees for the pay periods for the preceding completed 12 months. Revenues, 3-year look back, recently completed fiscal year. Employee, 12-month look back for the immediately preceding completed pay periods. Now, obviously, I was just talking about size, but you should know that the rules, generally speaking, when it comes to certifying what your business is and how you qualify for a set-aside program, they track generally across both the small business and socioeconomic regulations. You're going to see us use the phrase socioeconomic. What we mean is HUBZone, 8A, SDVOSB, WOSB. Now, I threw 8A in there. Know that some of these, the 8A program is, if any of you are participants in it, it's a beast of its own. And so we're going to try to touch on how the 8A program differs from some of the other socioeconomic representations.
And Megan, I would just jump in here too that most of the time when you're making these certifications, they're self-certifications. So as Megan said, you know that there is an investigation component and responsibility on the contractor making those certifications. But for some of SBA's socioeconomic programs, like the 8A program, the HUBZone program, and maybe coming soon the WOSB program, SBA will make that certification on behalf of the offerer. So you can't represent that your HUBZone or 8A giving you the go-ahead and approving your application.
But let's take an SDVOSB, or that's a self-certified. So let's take one of those certification ones that you mentioned, like an 8A or HUBZone one. You are still, and we'll go over this in a couple slides, you are still representing to the procuring agency that even though you've already been certified and blessed by the SBA, at the time you submit your proposal, you're still in good standing with the program requirements, you are still eligible.
And you'll see that's very particularly true and problematic for HUBZone companies, but that's in and of itself something different. So really quickly, we're going to talk about how the SBA regulations sometimes differ from the FAR. And as you know, your contractual requirements are always going to be FAR requirements. That's what your contracting officers know and love and are familiar with. But SBA has their own regulations, and so sometimes there's slight differences or tweaks between the two sets of regulations. But they generally coexist peacefully, I would say. For example, the SBA regulations, when you're recertifying either upon a merger or acquisition, SBA regulations say that recertification is required if the small business acquires or is acquired by quote-unquote another concern. And the FAR doesn't specify, doesn't make this distinction. And this can be work either to your advantage or disadvantage, as we're going to talk about later, with regard to whether or not the acquisition is done by another entity or another individual. Does that mean recertification is required or not? If it's done by an individual, for example, and the SBA regulations say you only need to recertify it if the acquisition is done by another concern, it's sort of an open question. But that's just one of the areas where the FAR and the SBA regulations differ. Generally, contracts requiring re-representations of size will contain the FAR clause FAR 52219-28, contractor re-representations of size, I believe is what it's called. SBA regulations also require recertification for all socioeconomic program representations, but the FAR doesn't have a similar clause for socioeconomic re-representations of status. They really just have the FAR 52219-28 for size re-representations, which are triggered either upon a novation, a contract novation, or a merger or acquisition. So it's a little bit of an open question whether or not your contracts technically require you to re-represent your status. Best policy is to always follow the SBA regulations, because SBA is going to be the ultimate arbiter on whether or not a contractor is in compliance with these requirements. And just to note, there is also a new proposed FAR amendment which will allow contractors to recertify new size or socioeconomic statuses upon every recertification that the contractor makes. So for example, if you undergo a merger or acquisition and the company that acquires you is a WOSB, and before you were just a small business, the new FAR or when the FAR regulation goes into effect, I should say, would allow that company to make a representation of WOSB status after the merger is complete. That's in opposition to SBA's regulations, which currently only allow for such recertifications upon subsequent option periods. So that's just something to look out for when the new FAR regulation becomes effective. So the general rule, oops, we skipped a little bit ahead.
Oops, sorry, we're having issues here. There we go.
There we go. So the general rule, so this is kind of like in a vacuum, none of the other exceptions or triggering events or anything else, and all the reasons why you're attending this webinar probably today would be effective. This is just the general rule. Is that representations of size or socioeconomic status are good for the life of the contract, even if otherwise natural growth occurs or you lose your eligibility. That's kind of like, this is the general rule, not the exception. So we'll go through all the exceptions later. And so where a concern grows to be other than small, the procuring agency may exercise options and still count the award as an award to a small business. So let's just talk about natural growth for a quick second. Natural growth means that, you know, you're doing a great job, your company is succeeding in business, you haven't undergone any kind of mergers or acquisitions or any other type of structural business corporate change that would otherwise require you to recertify your size or status. You're just, you know, you're doing so well that if you certified on a contract under a $15 million size standard, for example, and now all of a sudden your company, the past 3 completed fiscal years have been up to 20 million, you're like, oh, we're no longer small. That's okay. If the growth has been natural and it hasn't been due to some type of combination or merger or acquisition, you're okay to continue to represent that you're a small business under that contract. But here are all the reasons why you're attending this webinar today, right? Because there's a million exceptions to that general rule. There's exceptions for 8A awards, HUBZone awards, subcontracts, architect engineering, design, build, or 2-step sealed bidding procurements, agreements, all those amorphous agreements that you enter into, multiple award contracts. That's probably the big, there should be like an asterisk next to the multiple award contracts one.
I disagree. I think triggering events should have the asterisk.
Well, both. Two asterisks. Other long-term contracts and triggering events. There's a million different exceptions to that general rule.
Okay, well, there were only 8 bullets on the screen, not a million. So let's go through what each of those 8 bullets were.
First is 8A awards. As Megan mentioned at the top of the hour, 8A awards in 8A, the 8A program is a beast in and of itself. 8A is special because eligibility is determined at both time of proposal submission with price and at time of award. And the little caveat for the 8A program is that size may be protested, but your 8A eligibility is generally never protested. SBA can do that, but generally other disappointed offerors won't protest your 8A eligibility. And 8A is tricky because the contracting agencies have to offer to, and SBA has to accept those requirements on behalf of each 8A contractor. So for each award, the contracting agency offers, and SBA accepts the requirements into the program. So that's why there is that special requirement that you have to be an eligible 8A contractor at the time of the contract award. There is a little exception to this. There's always an exception within an exception, I should say, that if you've otherwise graduated from the 8A program and you submitted your offer while you were still eligible and you've graduated, you're eligible to accept that contract if it's awarded to you. However, the regulations just say graduate. It doesn't say terminated or otherwise exiting the program, which is a distinction that's made oftentimes within the 8A program. So that little exception within the exception only applies to 8A graduates. And then here's my favorite, HUBZone contracts. HUBZone contracts is also the other socioeconomic program where you have to meet all of the eligibility requirements for the program on 2 separate dates. The date you submit your proposal and the date the contract is awarded to you. And this is a little bit tricky because on both dates you're representing that you are a HUBZone eligible and concern. And as anyone who participates in the HUBZone program knows, it can be very, very complicated and tricky to make sure that you're meeting all the eligibility requirements points in time.
The next exception is for subcontracts. Subcontracts are a little bit different. This comes up obviously when you have a large prime who is subject to a subcontracting plan, a small business subcontracting plan, and then they need to determine at what point in time they should accept their subcontractor's representation that it is a small business or whatever socioeconomic category it falls within. A subcontractor's size status is captured at the time it submits its offer for the subcontract. So its offer, it has nothing to do with, that offer may or may not include price. It just is the time of offer. And at that time of offer, the certification can be in the form of written representations, or it can be what the subcontractor represents on SAM. And the prime contractor is allowed to rely on those written representations or SAM certifications, and meaning that if it's determined that the subcontractor falsely certified its status, its size status to its prime contractor, the prime contractor in good faith relied on what turned out to be a false certification. When the government investigators come knocking, the prime contractor is not going to be liable to the government. The sub may be, but the prime contractor is not. And absent a term or condition in the subcontract, the subcontractor is not required to go and tell its prime contractor, my status has changed. I am no longer small. I've been acquired. That is generally not required unless you have something in your contract that does require you to make that representation. This is a very similar exception for architect engineering, design build, or 2-step sealed bidding procurements. The concern who is bidding, the bidder, offerer, must qualify as small as of the date that it certifies that it is small as part of its initial bid or proposal, which may or may not include price. Again, this is an exception for the general rule, magic point in time, offer including price. But this is one of the exceptions because it's just offer, may or may not have price.
Quickly, we'll talk about agreements. This includes blanket purchase agreements, blanket ordering agreements, and basic agreements. Similar to, this is not really so much as an exception, but more like kind of like a warning, I would say, that you make your certification with regard to the agreement at the time of the initial proposal submission, which includes price, but because the FAR is very clear that agreements are not contracts in and of themselves, and it's really the underlying order, the orders that are issued to the contractor against those agreements that are the contracts, you also have to represent your small business or socioeconomic status in connection with each order in order for the agency to receive small business goal credit or whatever socioeconomic credit that you're otherwise representing to. So it's each order that counts.
And I think you just actually received a question about this. Currently is the next one.
Yeah.
We are currently a small business with a BPA under our GSA schedule. At our GSA schedule option this year, we will need to recertify as a large business based on our 3-year revenue growth. After the schedule option recertification, will remain a small business for a BPA, or would we be immediately considered a large business under the BPA?
So good question. We have a whole slide that addresses the issue because BPAs issued against GSA schedules, they're kind of an exception to the BPA rule. This whole webinar should be just titled Exceptions to the Rules. But for BPAs issued against GSA schedules, the contractor may rely upon the representations made at the schedule level for that BPA. So if you're submitting an offer on a BPA that's issued against, like, let's say your GSA IT 70 schedule, and you're no longer a small business and it's a small business set aside, but your GSA schedule has a small business representation on it that you haven't otherwise been required to re-represent. You can submit an offer for that BPA because BPAs issued against GSA schedules are special and you can rely upon that small business certification. However, because essentially all orders issued under the BPAs established against your schedule are going to ultimately be fulfilled or ordered against the GSA schedule, once you've made that re-representation of size at the schedule level, so let's say, for example, you get your small business BPA award on year 4 of your 5-year ordering period on the GSA schedule. So on the 4th year, you get your BPA. You're required to re-represent your size on the 5th year, but your BPA was good for 3 years. Once you re-represent your size against the GSA schedule, you're not able, or you can keep the BPA, but the ordering agency is no longer able to take small business credit once the size representation at the schedule level has changed. That's actually a requirement in the FAR we'll talk about a little bit later, but that is an issue, I think, because people think that the representations of size they make on the BPA should last for the total time period of the BPA. But if you change your schedule representation, that's not the case.
So it seems like with BPAs, it's the schedule controls.
For GSA scheduled BPAs.
Yeah. For GSA scheduled BPAs, the schedule controls. Whereas BPAs under multiple award contracts, who knows?
That would be a regular BPA that you would follow the first rule where you would have, so if it's a regular BPA, not a scheduled BPA, follow the rule that we talked about earlier that you have to make that representation of size for each order. But multiple award contracts are special. So if a concern is small at the time of its initial offer for a multiple award contract, then it will be considered small for each order issued against that contract with the same NAICS code and size standard, unless the contracting officer requests a size recertification in connection with a specific order. And we should say, too, that a size or socioeconomic status recertification, contracting officers are always able to ask for whatever recertification they want in connection with specific orders. So for these specific recertification requests that come at the order level, it has to be specific so that if you're not sure what's being asked in the task order, the RFQ for the task order, get clarification from the contracting officer. That's the perfect time to submit a question saying, is this an explicit request for recertification of size or status? Simply a task order RFQ simply incorporating the standard set-aside clauses, that's not enough to be a specific recertification requirement. There needs to be some language in there saying we are requiring offerors to re-represent their size. And when a concern grows to be other than small, the agency may exercise options and still count the award as an award to small business. So speaking of multiple award contracts, you're asking what are we representing to? It's the NAICS code that you originally certified that you were either small or you had that you were small under. So representation is based on the size standards set forth for each discrete category that you've represented to. So the CLIN, the SIN, the sector, the functional area, or whatever segment of the contract we're talking about. If you submit an offer for the entire contract and there's segregable portions of the contract, SBA may require you to make sure that you meet the size standard for each of these discrete categories. And if you're small at the time of the offer for that discrete category on the MAC, you're small for each order issued against that category with the same NAICS code and corresponding size standard. So that's something I need to emphasize. So you see this issue sometimes arise in GSA schedule world, right? When you've made a representation for a specific SIN that you're small under NAICS code XYZ. And then contracting officer issues a task order request under that SIN and with the NAICS code attached to it of ABC. Well, you didn't necessarily represent your small business size status for ABC, you did for XYZ. So what do you do in that instance? Technically speaking, it's the size representation you made at the schedule level that counts, and that was for XYZ. So you haven't made a representation of size with regard to ABC. That's why there is a general rule that all orders under MACs must be assigned the same NAICS code as the underlying contract. In practice, that's, we don't see COs always, adhering to that. So MAC orders to 8A firms. This is a very, very, very complicated rule, especially for 8A contractors that have GSA schedules. I think this rule is not intuitive, and it's buried deep within the heart of the 8A regulations. I mean, you really have to hunt for where SBA has laid out when you're allowed to compete for 8A set-aside orders and when you're not allowed to compete for 8A set-aside orders.
And we've already received one question about this.
Okay, so here it is, and I'm sure you'll get it all the first time, right? So for multiple award contracts, the differentiating factor is whether or not the underlying vehicle was competed exclusively amongst 8A participants. And a way I always think about it is think about GSA's 8A Stars 2 contract. That's a vehicle that's only eligible for 8A contractors initially, right? So you have to be an 8A company to have a GSA 8A Stars 2 contract vehicle. But some multiple award contracts are available for everybody. Anyone can compete on them. And you're allowed to represent your 8A status at the time when you submit your offer for that contract. So that's like a GSA schedule. Let's think about GSA schedule IT70. You don't have to be an 8A contractor to have an IT70 schedule, but you're allowed to represent your 8A status to get on that schedule and compete for 8A set-aside orders under that schedule. So that's the difference between competed exclusively and not competed exclusively. Think about it as a difference between 8A Stars 2 versus IT70. So the regulations say when the contract has been competed exclusively, you're eligible to compete for set-aside orders even if the contractor has otherwise exited the 8A program. And this reason is because SBA, or the ordering agency, GSA in this case for 8A Stars 2, offered, and SBA has accepted that contract into the 8A program. So the offer and the acceptance have already happened for the entire contract. However, for IT70, no offer and acceptance has been had by SBA. So SBA requires the contractor or the ordering agency to offer and the SBA to accept each individual set-aside order into the 8A program. So for contracts like IT70, where it was not competed exclusively amongst 8A participants, you have to be a current 8A participant to compete for 8A set-asides. So if you've graduated or otherwise exited the program, you're not eligible to compete for 8A set-aside orders. And I know this could come as a shock to a lot of 8A companies that have otherwise, been competing and maybe even winning some of these 8A set-aside orders even after they've exited the program. And I think the real reason is because ordering agencies don't know what they're doing, right? But this is the technical rule in SBA's program, SBA's regulations.
Well, I think we've also seen recently that SBA is pushing for this.
Yes.
That particularly, Katie and I have both encountered with GSA schedules, when SBA receives notice that GSA intends to make an 8A set-aside task order award under a GSA schedule, SBA, I have heard, gives the procuring agency a list of vetted, eligible 8A contractors. And if a graduated 8A is not on that list, which they wouldn't be because they are not currently eligible, they will not be able to even submit a proposal for that task order, despite the fact that on their GSA schedule they are still listed as an 8A contractor.
And another little caveat to that is in 8A world, you can't rely on your underlying schedule size representation for the 8A order if you've otherwise undergone natural growth and have exceeded your size standard, because part of the offering and part of SBA's acceptance into the program is their confirmation that the contractor is a small business, quote unquote, under the NAICS code assigned to the order. And what that means is they want to see that you're currently small. I've argued with SBA over this point because I don't think that makes any sense whatsoever, but that is currently SBA's current policy. So they require you to be small as well. So for directed sole source awards, SBA must always accept that order into the program. So that means you have to be a current 8A participant. Quick note on this: there should never be any directed sole source awards under GSA schedules. I think that's that's not in the ordering authority for the GSA schedule program, but we hear about that a lot of times anyway. Options may be exercised if you're in the 8A program. Options may be exercised, your contract option periods, so long as they're priced options. Otherwise, you have to be a current 8A participant, and the contracts may be modified so long as the modifications are within the contract scope. Again, otherwise you have to be a current 8A participant.
So the next exception is for long-term contracts, and this includes multiple award contracts. So multiple award contracts or any other contract that is more than 5 years in duration is considered under this regulation by SBA a long-term contract. So for contracts with durations of more than 5 years, including options, the contracting officer must request that the participants on that, the contract holders, recertify their small business size or socioeconomic status within 60 to 100 days prior to the end of the 5th year of the contract, i.e. right before the option period, and within 60 to 120 days prior to the date specified in the contract for exercising any option thereafter. So there are contracts out there that have a 5-year base period and 3 5-year option periods. So 60 to 120 days prior to the expiration of the 5-year base period, the contractor is going to be required to recertify. And then prior to every option thereafter, they are going to be required to recertify their size or socioeconomic status. We often think of this as a rule that can negatively impact a business, that if it was small or it had a certain socioeconomic status and then they have to recertify and they are no longer eligible, it can impact the business, and we will get to that. But it can have a positive effect, and that's what this next bullet covers. A business concern that certified itself as other than small, either initially or prior to an option being exercised, may recertify itself as small for a subsequent option period if it meets the then applicable size standard. So in other words, you can get yourself back into the contract and allow the agency to take credit for you as a small business or based on your socioeconomic status if there's been a change for you. So I said that triggering events were the most important term in recertification. So what are triggering events? This applies to all contracts, including multiple award contracts, all set-aside contracts. And the two big categories you should think about as a triggering event is novation or merger, sale, acquisition. Novation, merger, acquisition. Generally, upon one of these triggering events, you are going to need to recertify your size or status to your customer agency. And generally, the set-aside contracts include FAR 52-219-28, which requires re-representation of size. There's no equivalent clause for socioeconomic programs, but that doesn't mean that you're not subject to a re-representation for your socioeconomic status. You are. It's in the SBA regulations. And this is something that one of the areas that we excel in for our clients is that we are so familiar with the SBA regulations that when we are assisting a client with a novation or a merger or acquisition, we can flag this issue for them. So what is a novation? Novation, the definition is a substitution of a new contract in place of an old one. Well, what does that mean in government contracting? There's a law that says that government contracts in and of themselves cannot be sold or transferred. They are not assets that may be sold. And as soon as I say that, you're probably thinking, what are you talking about? Government contracts are sold all the time. I know so-and-so just took over this contract for such and such. That's because they go through the novation process. So because there's this general rule that government contracts cannot be sold, the government has come up with this way in which the assets associated with a government contract, when they are transferred to another party, and that party is going to step into the shoes and continue performance of the contract, they have to get the government's blessing to do so, and that's a novation. Novations arise in an asset purchase. So when the assets of a contractor, either all or some, are purchased, that's when this novation issue is going to be triggered. Name changes do not require recertification. That's a whole other animal where you have to go through a change of name agreement. It's not as burdensome as a novation, but you still have to get the government's blessing. But if your company is involved in an asset purchase, the little bell in your head should go off that says, I'm going to need to novate my contracts. Besides novation, the other triggering event you need to be mindful of is merger, sale, or acquisition. Now, what's interesting here is this is language directly from SBA's regulations. The FAR doesn't make reference to a sale. The FAR just says merger or acquisition. Now, do I think this has any meaning to it? No. But I just mentioned it that SBA is really trying to make it very clear here that if there's a sale of your company, if there's a merger, if there's an acquisition, we want you to recertify. So this arises, I told you, novation is for an asset purchase. Merger, sale, acquisition, that's structured as a stock purchase. So when the equity, the interest of your company are acquired, that's when this is going to be triggered. So in the case of a merger, sale, or acquisition, where contract novation is not required, the contractor still must, within 30 days of the transaction becoming final, recertify its size or status to the contracting agency. Now, this is where SBA gets you. In SBA's regulations, and this is not in the FAR, and this is only in SBA's size regulations. This is not in the various socioeconomic regulations, not in the WOSB, SDVOSB, or HUBZone. So when it comes to your small business contracts, you need to be aware that besides novation, besides merger or acquisition of your company, if an affiliate of your company is acquired, SBA now wants you to recertify. And SBA wants that recertification both from the acquired concern and the acquiring concern, if each has been awarded a contract as a small business. So both buyer and seller, if the buyer and seller have each been awarded a contract as a small business. And then here's the trickiest one of all. SBA wants a recertification from a joint venture when an acquiring concern, or merged concern is a participant in a joint venture that has been awarded a contract or order as a small business. So let's say Katie and I form a joint venture, my company and Katie's company. Katie's company is acquired by Boeing. I have nothing to do with the transaction. The joint venture has nothing to do with the transaction, and the joint venture is performing a small business contract. Under this rule, because Katie was acquired by Boeing, and that's an acquisition, and therefore Katie's company is an acquired concern that is a participant in the joint venture itself now must go tell its customer agency, there's been an acquisition within the joint venture. One of our members is now owned by Boeing. This is another relatively new rule where SBA is trying to trip people up.
Tricky SBA.
If the merger, sale, or acquisition occurs after offer or after submission of your proposal, but prior to award on a set-aside contract, a small business contract, the offeror must recertify its size to the contracting officer prior to award. This is, like I said, a new rule. It was just published last year, and it's frankly unclear whether upon that recertification the agency would be allowed or even willing to award that offeror contract based on the recertification. So let's get down to brass tacks. What does all of this mean? The recertification, novation, merger acquisition. Why do I care? The reason you care is this is going to affect the value of your company. If you are looking to be acquired, if you are looking to sell off some of your contracts, if your contracts are subject to these recertification requirements, that's going to limit your pool of buyers. Because a buyer, if they are not able to step into your shoes and make the exact same recertification to the agency and say, I am a small business, I am a WOSB, whatever the case may be, the buyer is going to have to tell the agency, I am not a small business, but please don't you want to keep working with me? And there's no guarantee that the agency will say yes. So this is going to limit your pool of buyers. You're going to get the most money for your book of business from buyers that are similarly situated to you. So another trick to all of this is, what about an ownership change? I've talked about merger, sale, acquisition, and the SBA regulation says acquires or is acquired by another concern. So if Katie and I are in business together and I decide to buy Katie out, I am one individual buying out Katie's interest. I am not a concern. And a concern in SBA's world is an entity. I am an individual, a person. Therefore, there is no requirement for us to go and tell SBA. And frankly, there wouldn't be a requirement to tell our customer that there was a change of ownership. There's one FAR clause dealing with change of ownership, and it only comes up in contracts that require certified cost or pricing data, or for which a pre-award or post-award cost determination will be subject to FAR 31.2. And the notification for that FAR clause is just to if it affects the contractor's business assets. Here, if the assets of the company in my scenario are going to be unchanged, and Katie wants to go and retire, I'm simply buying her out, that should not trigger this recertification requirement because I am not another concern.
So just a quick shout out to the 8A program because we can't talk about it enough, I guess. You can't transfer your 8A contracts. So Megan was just talking about novation and how that's really the way you would effectuate a contract transfer under these rules, but you can't transfer 8A contracts without a waiver from the SBA. So that's just an important caveat. And if an 8A contract is transferred without SBA's waiver, it will be terminated. So that's when I think we also add a little bit of value to, or some value to our clients that are undergoing mergers or acquisitions or sales, because we can spot those 8A contracts and the notice requirement to the SBA, and that's where we can help you identify those contracts that you have to get the SBA approval. And also, recertification and triggering events do not apply in the 8A world, as we've talked about previously. And also, actually, there is an ownership. Megan was just talking about ownership changes. SBA's regulations for the 8A program also require SBA to approve any ownership change in the 8A program for an 8A contractor that's above 10%. You need to get SBA's approval.
With that said, we have definitely helped clients in the acquisition of 8A contracts. It's definitely doable. It's tricky. You have to have an 8A buyer. So it has to be an 8A seller to an 8A buyer. I will be very candid and tell you we see it very often when 8A firms are in their 8th year. They're approaching graduation. They realize, and maybe they've just won a contract that has 5 years and maybe another couple of options to it. So it's a very valuable 8A contract, and they can sell it to someone who's just got into the program, and they can start using that.
So we've talked about it enough, but what does recertification really mean? And we're also going to talk about what its effect is. But it means that you have to tell the contracting agency, usually the contracting officer, that either you're still small, or you're still HUBZone, or you're still WOSB for the contract. So you're affirmatively providing a representation, again, to the contracting officer. I am small. You recertify for size recertifications. You recertify under the size standard effective at the time of the recertification, assigned to the contract's original NAICS code. So if the size standard has increased since the time you submitted your initial certification of small business status and went up another $2.5 million or something, from $15 million to $17.5 million, you recertify. At the time you make your recertification, if the $17.5 million size standard is effective, that's the size standard that you recertify under. And technically, recertification does not change the terms and conditions of the contract. You get to keep that contract. So if it's a small business set-aside contract and you're required to make a recertification of size and you're not small anymore, that doesn't mean you lose the contract. You get to keep it. And the agency can continue to issue orders and options under it. It just means that they can't take the small business credit anymore. One thing to look out for is some contracts do have off-ramping provisions. So if the contract requires you to leave the vehicle if you're no longer small, you need to remember that and know that. So the effect of recertification means that so let's say you can't represent that you're still small. So after you've represented that you're other than small, it's the onus is on the ordering agency now. So the agency is no longer able to include in its small business prime contracting goal achievements the value of the options exercised, modifications issued to the contract, orders issued, or purchases made against under BPA on that contract. So all of those things, all of the value of all of those contracting actions are no longer able to be included in the ordering agency's small business goals. The agency also has to report that the contract has been updated in FPDS, and contractors that are no longer small may be required to adopt a small business subcontracting plan.
And I just want to kind of break this down a little bit. I think everybody knows that the overall government-wide spending goal for small businesses, and this is all of the programs in one, is 23%. And then there are individual goals for the various socioeconomic status categories, but again, that falls within the 23%. SBA then gives each procuring agency its own individual goal that may or may not be above or below 23%. So if you are a potential seller and maybe your buyer is not a small business, they are interested in purchasing your company or your contracts, which would be a triggering event, whether it's a stock purchase or asset purchase, and they would need to recertify as other than small. What you might want to do is check on where your customer is in their spending goal. If you're a small business and they're at, their spending goal is the 23% and they're killing it and they're doing 30% of all of their dollars are going to small businesses, then losing your one contract after the sale in the recertification, they can still have your successor in there performing, but they wouldn't be able to take credit for that contract anymore. That might not be the end all be all for that agency if they're otherwise meeting their goal. So that's a good way to kind of forecast what's the likelihood that this will truly have an impact, i.e. lead to termination of my contract. Where is my agency on their spending?
And finally, we're going to talk quickly about the penalties for false representations. So a few years ago, SBA officially codified in its regulations the presumed loss rule, which says that for their SBA will essentially, or contracting agencies for that matter, will have a presumption of loss if you've made a false representation of size or status. And it's for every contract, subcontract, cooperative agreement, cooperative research and development agreement, or grant which is set aside, reserved, or otherwise classified or intended for award to a small business or a HUBZone and 8A. So every time you make a representation of size or status, you're kind of on the hook for this. SBA takes this very seriously. There can be both civil and criminal penalties attached to false representations. And we've seen, just on our end, a very large uptick in the number of SBA investigations. For whatever reason, I think maybe with the administration change or what have you, we've seen a lot of investigations from the SBA's Office of Inspector General. And actually, the ordering agencies as well have large upticks in the OIG investigations based on representations of size or status. So, as Megan said at the start of the hour, anytime you make a deemed certification, so you're saying you're small, or you're saying you're HUBZone, or you're saying you're 8A, that puts you on the hook for this presumed loss rule.
And just to make it super clear, the presumption of loss to the United States is the value of the contract. It's not what you've actually been paid. If you are awarded a $10 million small business contract based on your false certification and your company is not actually small, and the government finds out, and you've only been paid $1 million under that contract, guess how much you owe the government? Under this presumption of loss rule, you owe the government $10 million.
And it doesn't matter if you've done a bang-up job. You could say, well, you got exactly what you bargained for. We've been doing a fantastic job. It doesn't matter. Now, we should also say, too, as a caveat, this is if you've made a intentional misrepresentation of size. If you've, as we've talked about, some of these rules are incredibly tricky. So if you've done your good faith, due diligence and homework to make sure that you're making a good faith representation, I don't want to say that that's enough to, keep you free and clear, but, that counts.
So we're running out of time. What are some questions we can tackle before we're totally out of time, Katie? And if we don't get to a question, you're free to email either or both of us. Our email addresses are on the screen. Oops. Oh, hold on.
Sorry.
There we go. Oops. There we go.
No.
Yeah. Okay. You need to stop. Yeah, there we go. Okay. We're just looking at questions now. Will the slides be posted? Yes, they will. You'll get a link. We'll send you a PDF. Are there any penalties for a company that allows their SAM.gov reps and certs to expire prior to the due date of a small business set-aside RFP? And the case may be that should the company have updated their SAM records, they would have no longer been a small business and could not have submitted a bid in the first place. Yes. Yes, you need to make sure your SAM is up to date. And in fact, the certification rule has many reasons why it's important, but one of the reasons the certification rule is important is because that triggers a size when other companies can file a size protest. SBA, under SBA's own regulations, they can file their own size protest against your company based on your SAM certification. So it doesn't even have to be attached to an RFP or a procurement. If SBA suspects or has reason to believe or just frankly wants to file a size status based on your SAM representation, they can and will do so.
Got a question about the HUBZone program. Are there requirements about when you recertify if you are qualifying by the number of employees living in a HUBZone? So, correct. I mean, every time you make a HUBZone certification, you are certifying that you meet all of the HUBZone program eligibility requirements, that your office is located in a qualified HUBZone, that the greatest number of your employees report to that principal office location, and that you're abiding by the 35% HUBZone resident as your employee. So you have to meet all of the HUBZone eligibility requirements on date of proposal submission and date of contract award.
We have another question from Amy. What platform does the federal government rely most on, SAM.gov or SBA's website, DSBS? And the answer is both. And the reason it's both is because the information you input in SAM actually populates DSBS.
Any news on the new 52219-14 that just came in? And that's something interesting. So no, as far as we know, the FAR Council still has it and is holding it. So there is still the discrepancy between the limitations on subcontracting in the SBA's rules and the limitations on subcontracting requirements in the FAR. So there is still, we were talking a little bit before how SBA regs and the FAR can differ. That is definitely one of the areas, and we don't have an update on when that new FAR clause will be published.
We have a question way back from the beginning. Are the revenue calculations based on income reported to the IRS? The answer is maybe. And the reason the answer is maybe is because, and Peter, I'm not suggesting that this is the purpose of your question, but we have clients that tell us, my tax return is not final yet, therefore I'm just using my old numbers to do my size calculation. And that is frankly not good enough. So if your tax return is not final, but you have financials and you can do a cash basis accounting to determine what your tax return likely would say with regard to your size calculation, it's incumbent on you to do so.
We also have a question on whether we can comment on the SBA double counting of JV revenue in determining a size standard. So if the question is that, how do you determine if you're small, how do you apportion the revenues of the JV? Technically speaking, each company, each participant in the JV should account for those revenues based upon the work that it performs. So if you perform 60% of the work of the joint venture, you should attribute 60% of the JV's revenues to you.
So the answer to Jim's question is no, there's no such thing as double counting of joint venture revenue.
Mm-hmm.
So there is potential double counting when it comes to inter-affiliate transactions. But a joint venture, for purposes of your size calculation, is not an affiliate and therefore does not, the revenues of the joint venture, the total revenues of the joint venture do not need to be included. Rather, it's just your proportionate share of the joint venture's revenues are included in your size calculation.
What is the impact on size in a solicitation that is identified as unrestricted? So actually, this is a good question. So even if it's an unrestricted solicitation, the ordering agency can still count, if you're a WOSB, for example, as you've put in your question, the ordering agency can still take credit for WOSB dollars if you represent that you're a WOSB, even in that unrestricted order. So they can still check that box in FPDS and take that credit.
Someone asked, we are certified SDVOSB with the VA. My question is, if the VA has certified us as SDVOSB, then are the NAICS codes applicable for VA opportunities? The answer to that question is yes. there appears to be two sets of guidelines, one with SBA and one with the VA. The answer to that is yes, and being an SDVOSB is very tricky. So if you, as an SDVOSB, want to do business with the VA, you have to do exactly what you did and get certified with the VA. If you want to do business with the rest of the federal government as an SDVOSB, you need to follow SBA's regulations. Someone resubmitted their question. 13 CFR 121.404 requires size as of time offer is submitted. However, 13 CFR 124.507 allows SBA 5 days to conduct an eligibility determination. For an 8A joint venture, when must they certify? So this is, so Katie wants to say something, but I want to say real quick that 8A joint ventures, don't think that any of this is, 8A joint ventures are a beast in and of themselves. And the reason that they are a beast in and of themselves is because SBA has to approve every joint venture for every 8A contract that it's pursuing. So the truth of the matter is it will be certified when SBA says it's a certified 8A joint venture.
That's true, but again, as we clarified at the top, as one of the exceptions, 8A requires you to be eligible on time of proposal submission and on time of award, and that's exactly for that 507 caveat that you called that says that SBA gets 5 days to conduct an eligibility determination. That's the quote-unquote time of award.
Alrighty, well, thank you all so much for attending our webinar today. If we did not get to your question, we will answer it. We will send you an email. And again, if something else comes up, if you're thinking about this topic some more, as you should be, please feel free to email us. Our email addresses are on the screen. You will receive the slides via email. This will be posted on our website. You'll be able to watch it again on demand. Thank you and have a great day.